Hey, listeners. Today I had on Matt Jobbé-Duval, the co founder of CoinWatch. Now, you probably haven't heard of CoinWatch, but it's a token launch advisory firm that does things like negotiate market maker deals on behalf of clients. And it's worked with some big teams, including Jito, Optimism, and Sui. I wanted to get Matt on to talk about something that's very interesting to me, which is crypto market making. How do these deals work? What are the bad actors seemingly doing? And why do new crypto tokens sometimes go to zero in a day? Matt didn't disappoint, so let's get into it. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today by Matt Jobbé-Duval, the co-founder and CEO of CoinWatch, a crypto token market-making kind of advisory firm, and someone that really has a lot of interesting things to say about maybe one of the most shadowy realms in crypto today, which is how market making works behind the scenes. Very excited for this conversation. So Matt, thank you for coming on the show.
Thanks for having me, Jack.
I think I'm just going to start out and, there's a lot to dive into on this topic, but maybe just to set the table for listeners. What is market making in crypto? How does it work? And how is it different from maybe how market making works in traditional markets?
Sure. So market making is just that, making a market as a full-time job. Making a market in trading parlance is the act of providing a bid price, a price at which you will buy, and an offer price, a price at which you would sell. When you provide both a bid and an offer, you made a market. And someone might buy from you, meaning you as the market maker sell, or someone might sell to you, meaning you as the market maker will buy. And that's market making. Now, the job of market making is exactly the same in crypto and in TradFi. And it's really about putting a lot of these bids and offers around the latest price that the thing is trading at, whether it's a piece of equity, a piece of commodity, or crypto, a token, that we call the mid price. So the more orders the market maker is going to provide around the mid, the better liquidity will be made available for that token, which means that ultimately someone who wants to come in and buy a large amount or sell a large amount of that token will be able to do so at a price closer to the mid price than what they would have achieved if those orders had not been there.
Well put. But, I would think you say that it works the same in crypto as in, TradFi, but crypto markets, much less liquid. A lot of these tokens are probably, I would think, much more difficult to profitably quote bids and asks for. So what are the novel considerations when you're, providing liquidity for random ZK infrastructure token versus, Tesla stock?
Absolutely. So there are two major differences on the asset level, which have direct implication in terms of how market makers are actually incentivized to do that job. The first difference is the volatility that token have versus equity. If we look at anything that's in the S&P 500 versus any token, especially for the first year of that token, the volatility is going to be anywhere between 2 to 5 to 10% larger in cryptocurrency, meaning something that would move 20 to 30% a year, which would be considered somewhat volatile in equity or in commodities, actually, would be more like 100, 150, even 200% annualized in crypto. If you look at actually day one launch, when you look at something like Pump, for example, yesterday that was up 20%, if you were to annualize that, that's around 400, 500% of annualized volatility. That's crazy. Now, that's the first thing. Now, people might think, oh, but that's great because market making make money off of volatility, right? So because if a price of a token moves a lot, right, goes up and goes down, and the market maker sells high and buys low, remember, they're putting orders, so they're going to mechanically be selling above mid when the price rallies and buying below mid when the price goes down. Market maker make more money when there's volatility. Well, that would be true if tokens were what's called in trading parlance mean reverting, meaning when they go up, they have a good chance to go down and vice versa. Crypto is really not like that. And we can take, a lot of examples, some on the upside, like Solana, right? Started at 75 cents, went to $200 in about a year and a half. That's a straight line up. And of course, a number of other tokens, just take Move, not to be cheeky, but really which started at $5, $6 and which is now at 15 cents. So because crypto has this intrinsic trend that is really baked in the core of the token, the job of the market maker is extremely difficult, meaning that when something starts to go up, it goes up a lot and every day, and it will not stop going up, and vice versa. As a result, the market maker who's providing offers on something like Solana, for example, will be continuously selling and selling and selling as price goes up. And of course, getting shorter and shorter and shorter an asset that you really don't want to be short, right? Something that only goes up. The opposite is true. Because of that, the job of market makers in crypto is incentivized in a vastly different way than the job of market maker in traditional finance.
And I guess to be more concrete, like how do these market makers, avoid becoming too short and getting wiped out? Like how do they actually make money?
Absolutely. And so this is a bit of history trivia, if you wish. And again, I wasn't necessarily front row back then, but this is back in 2017, 2018 for the Blockstack token launch. And so Blockstack went to talk to Jump and GSR. And they were exactly looking for that, for market making services, liquidity services. And so both Jump and GSR were like, okay, how should we get paid for this? Because this is risky, right? They saw crypto is already mean, follows trends very aggressively, and crypto is extremely volatile in general. So how should we get paid? The retainer was not necessarily going to make sense. A loan, which is the TradFi model, right? The large loan of equity to be able to market make as working capital, was not going to cut it either, right? Remember, if you sell the loan and then you have to pay back the loan a year or two later, wait, but I can't buy back the tokens that I sold. Now they're way higher than they used to be. So they all kind of went with their quant department to think about what could they do to be paid in a way that would protect them against massive run-up. And the jury is still out on who came up with the structure, either Jump or GSR, but they essentially came up with this really elegant structure, which is essentially a call option to protect the market maker. And the call option is embedded in the loan itself. So typically, a foundation, the protocol, is going to lend to the market maker a chunk of token, and the market maker at maturity, typically 1 year, sometimes longer, but typically 1 year, at maturity will return to the foundation either the tokens that they borrowed or a fixed US dollar amount. And the price at which the market maker is able to return the dollars, so essentially to purchase the token from the foundation, that is the strike price. The strike price is the price at which you can purchase the option in normal option parlance. So with that, now the market maker is protected, right? You're the market maker for Solana. Again, Solana example. You start the market at 75 cents on day one. A year later, it's at $150. It's all good because you can actually buy back the tokens at $1 from the Solana Foundation because that price was established at launch. And at launch, things were cheap. So you can sell Solana all the way up from 75 cents to $1 to $5 to $50. It doesn't matter because ultimately you can buy back everything at $1 from the foundation. And so that structure was really very elegantly allowing the market maker to do their job throughout the life of the trade, as long as they were not running out of SOL, of course, and also to be paid handsomely, potentially, because if the asset was going to have a very big up trajectory, the market maker, unless they sold everything early, of course, but otherwise they would set to be paid a good amount, which of course the foundation would be super happy about it because, hey, the tokens are up a lot. So I don't care that the market maker is receiving a big paycheck because the tokens that I'm holding are worth way, way more than they were at the beginning of the deal.
But this seems to create some maybe perverse incentives, right? As far as like what happens at the end of the call option with the market maker. And I think that is, to my understanding, where a lot of the highly publicized, blowouts that happen with these crypto market making deals happen. Is that right?
100%. So the call option, when I describe it like that, it sounds pretty ideal, right? The foundation only pays if the token price does extremely well. If the token price doesn't do well, the tokens are returned. So it looks like this was a free, deal for the protocol, right? They just lent something, they got it back a year later. what could go wrong? Well, actually, a lot can go wrong. And really, it's not necessarily the call option itself that's evil. It's really the ways that it can explode and create something extremely toxic. So let's look at a couple of ways where things can go wrong. The call option might be way too big, right? And so when you have a call option that is way too large, and when I say too large, it means that the loan extended to the market maker represents too much of the circulating supply, too large a portion of the circulating supply. There are a few examples out there that I cannot get into because some of the deals that we advised on against doing that. But anyway, market makers, of course, as you can imagine, prefer mega loans, right? And very, very large options. So on these deals, what happens? There is something that's called the magnet effect of a call option, which means when the call option represents too big a part of the circulating supply, the strike of the call option is going to act like a magnet towards which the price is going to converge all the time. Why is that? Well, think about it. If the market maker, let's say in a crazy scenario, they are in control of 99% of the circulating supply, right? And the rest of the market is only 1% of the circulating supply. As soon as the price of the token goes above the strike, the market maker, through gamma trading, is incentivized to start selling, right? Because they want to capture that increase in delta. That brings back the token price to the strike price. Now, if the token price goes down below the strike price, the opposite happens. Through gamma trading, the market maker is incentivized to buy back whatever short they put in place above the strike, and that makes the token price rally back to the strike. And because of that, if the option is too large, the token price basically cannot achieve healthy price discovery. It's stuck at the strike. And that's a big problem because the market is no longer representative. The market no longer works. It's completely controlled because of that gamma trading effect. That's number one. Number two, again, coming from the size of the option, if the loan is too large and the market maker feels like the token price is about to go down, and God knows that in crypto, unfortunately, this happens quite often. The market maker now has a lot of tokens that they can potentially sell. Nobody else has tokens at that point in time. Between day one and day 365 of a token launch, usually investors are not vested, team is not vested. Foundation has some tokens that are liquid, but they're for grants, etc., etc. Typically, they're not selling too many tokens around launch. So really, market maker are among the largest single holders of tokens. And through that, if they feel that the token price is going to go down, it's way better for them to sell the loan that they received than to sell on perps, for a simple reason. Selling on perps gives you two extra risks. Liquidation risk. If the spot was to jack up higher, your perp position is blown out if you're too leveraged, number one. And number two, funding risk, right? And you don't have to look very far to look at crazy negative funding rates these days. You pay that when you're short, right? And so if a lot of people go short on the perps, well, actually, it's very costly to be short, and that's not good. Whereas if you hold the tokens, not only you can go short the spot for free, right? There's no funding to pay, there is no interest rate to pay on these market-making deals, but also you can capture the perp arbitrage, meaning buy the perp, which is now paying you funding rate, and sell spot. So because of that, now the market maker has a lot of power with a big loan, with a big call option, and potentially they can use that power to sell all the tokens, not so much to hurt the project, simply because they think it's going down. So as a trader, as a hedge fund, if you think something is going down, you sell everything that you can and you buy back cheaper, right? And so that unfortunately has happened time and again. And sometimes it throws a wrench into the carefully crafted supply and demand picture that the protocol was going after in terms of sizing the circulating supply, sizing the airdrop, etc., etc. Because if the market maker is to sell 100% of what they received, that's really going to weigh down on the supply and demand dynamic of the token, meaning lower price, while not really getting anything out of the market maker, but allowing them to make money.
Okay, and you mentioned really interestingly that this was new history to me, but that GSR or Jump sort of pioneered this call option method in crypto. Is that how, to your understanding, like most or all crypto token market maker deals are done at this point?
So I would say in our experience, so CoinWatch has negotiated, call it north of 60 or 70 deals since our existence. Before CoinWatch, I negotiated myself probably around 30 deals on top of that. A deal meaning one protocol. Now, each protocol on average faces from 2 to 5 market makers. So that gives you a sense of how many deals I've kind of had my hands in. 95% of these deals were option deals for a simple reason. Oh, and let's look at the other model, by the way, before I explain the differences between them, if that's of interest to you.
Yeah.
Okay, so the other deal, which is very crypto also, is called the retainer deal. And the retainer deal is extremely interesting, and it's kind of crazy to think that this can exist and it would never hold water in TradFi, but this is how it works. A retainer deal is actually people think that it's the same as an option deal, except you pay dollars instead of giving a call option. So you lend tokens, and every month you pay, call it 10K a month on average, between 5 and 15K a month for the market maker to provide liquidity in an order book. So you want liquidity on the Bybit order book USDT, that's 10K a month. You want it on OKX USDT, 10K a month, etc., etc. So that sounds great because, hey, wow, that sounds a lot cheaper than an option, which potentially is going to be worth millions of dollars, right? By the end, if the token has done well. Well, there is a very interesting, small detail, but very important detail, which is the fact that the loan is not a loan, it's a deposit. So the foundation actually deposits tokens with the market maker, typically their own token, their native token, and a stable coin. It can be USDC, can be USDT. It doesn't really matter. The market maker is going to then swap for whichever pair is necessary. What's the main difference between a deposit and a loan? Well, a deposit, the market maker essentially at the end of the engagement is going to return to the client, to the foundation, whatever is in their wallet. Meaning if the market maker has done a bad job or the markets were horrible and they lost a lot of money, they're just going to return less tokens to the foundation. That's very different from the loan call option, right? Because remember, the loan and call option, you have two cases. Either you get back all the tokens or you get back an amount of dollars that you know from day one, right? The retainer deal is completely different. Retainer deals, market makers who are specialists in retainer deals like to say, oh, there is a rev share. If we make money, the protocol makes 60%, 80% of the P&L, and we take whatever is left. That's true on the upside, but on the downside, 100% of the loss is for the client. And that's very important to look at. It's also why market makers who specialize in retainer deals are able to raise at very, very lofty valuations compared to a trading firm, which is what other classic market makers are, simply because this is a business that looks amazing. You cannot lose money when you're market making on a retainer deal because any loss is passed on to the client. So these are the two main models. Now, of course, there is variations around the theme, but this by and large, 99.9% of deals fall into one of these two categories. Now, the difference between the two, cost, of course, option and retainer don't have the same PV. The risk profile is very different from the foundation, again. The retainer also is potentially not really giving you the same quality of liquidity. Why is that? Well, let's go back to the Solana example, which I'm going to use for the whole call, so let's get used to it. Market maker starts at 90 cents, right? You're the Solana market maker, day one, thank you very much. Let's go. Now, first day, 90 cents to 95 and to $1, and a week later, it's at $1.50, $2. Imagine being the market maker, right? So you show bids and offers, but really only your offers are being traded on. You keep on selling and selling and selling. Now, put yourself in the market maker shoes who, received the deposit of Sol and USDC in that example. That is a completely fictitious example, but in that example, so they would be running out of Sol very quickly, right? Because everybody's buying from them because the market keeps on rallying. It's not because of them. It's nothing to do with their butts. Just the market wants to buy. So they're going to run out of Sol super quickly. And so then they might say, okay, guys, Solana Foundation, we either you top up or, but we don't have anything anymore. And so Solana Foundation might say, well, no, I mean, we thought the deal would be for a year. So what are you guys doing? And so very quickly, the foundation would be like, what's going on? Like, we thought we had a market making deal for a year, and now we got to top up 2 weeks later. What are you guys doing? Are you never buying back? So they're a bit between a rock and a hard place. If they want to buy back, good luck to them, because the whole flow is going up. So buying is actually super hard, right? In such a market that just trends higher. And certainly the retainer that are being paid every month, the 10, 15, or 20K per exchange that they're covering, is never going to be enough to cover the trading loss of shorting something that keeps on going up. As a result, empirically, CoinWatch, the deals that we track, which is about 45 live tokens to this day that we track the market maker work for, when we look at the quality of liquidity that happens between a retainer deal and an option deal, you're in two different worlds. Meaning that when you need liquidity, retainer deals stop working. Retainer deals look okay when everything's quiet, when nothing happens, but when prices starts to go up a lot or down a lot, market makers pull everything for a simple reason. The retainers are just never enough to face the kind of loss they would have otherwise. So when you think about it, only when you really need liquidity, which is what stuff moves, it doesn't work anymore. So why are you even making a deal? So I'm not saying retainers are bad. I'm just saying they're only appropriate if A, the project doesn't have a lot of listing. Otherwise, quite frankly, the cost, if you add up the cost of every retainer on every exchange, you're going to be probably having something more expensive than an option. And in terms of actual results, you're never going to be able to match the quality of liquidity that you get from an option deal. This is only, of course, assuming that you track the work of your market makers very carefully to be able to make that determination, which by and large is still something that is, that's our business, but it's still not something that most protocols do.
Gotcha. And that's an interesting distinction. And kind of the reason I ask is it seems like a lot of these market maker deals are structured in similar ways. And if you're bringing a token to market, you're going to make these deals. But then now and again, and I have gathered a few examples, you'll get these tokens that just have insane looking charts. This is my favorite one. If you're watching on the stream, this is Polyhedra. What's the ticker? ZKJ.
TKJ.
If you if you're listening along, look up the Polyhedra chart at some point. But you can see that it kind of goes along at a certain market cap, spikes like 4x overnight, and then drops overnight as well. Another example I like here is Mantra. Very famously, I think it was like a top 20 token. It was, one of the large market cap crypto tokens, and very quickly lost 99% of its value or so. One more example I've gathered here is Solaire, which is a Solana ecosystem token. Kind of went up, relentlessly for weeks and months, and then overnight lost a ton of its value. And I think these charts are funny to look at, but I also want to ask, like, if a lot of these market maker deals are happening with the same structure, why do you sometimes see a token lose 99% of its value overnight, which to me is a big mark against, investor confidence in crypto markets?
What I'm going to describe doesn't necessarily apply to ZKJ and Layer and these other, and Mantra. Sure. We were not involved in the negotiation of these deals. They come from conversations I've had with founders, clients, potential clients, market makers, of course. CoinWatch has been in that business for a while, so we have an extensive network, and we have these conversations with a number of participants in these markets. And so this is my understanding of what has been going on. First of all, it's very interesting that you say this. Hey, how come some market making deals, retainer option, are completely normal, and the price of the token is behaving like a normal thing? It goes up, it goes down, but it's a pretty continuous process. And then some of these things happen. What exactly is going on here? Well, there is market making and market making, right? And so really what we're looking at when you look at these three charts, again, without having any details, and I'm not saying this is exactly the case, but what we're looking at is something that really looks and feels like price manipulation. But when you have something that goes up steadily, great, okay, wonderful. You probably have a good product, a great community, people who want to buy your token. How can it go down 90% over a few hours? If nothing has happened, your founder wasn't put in jail, or no big corporate news has happened, no big hack, how exactly can that happen? Well, this really feels like there was a deal somewhere that triggers this kind of cascade. And so let me give you my take on what may have happened on some of these tokens since the beginning of the year. This is very far from normal market making, from what we've just talked about since the beginning of this podcast. It's called active market making. And so I really like how crypto is able to come up with these really fancy names from time to time. And active market making sounds pretty good. It's like, we are active, these guys are passive. Boo, passive is bad, active is good, right? Active, actually, the first time I heard the term, I think it was coined by DWF about a year or two ago. And I'm like, what do you mean? And I've been a market maker for 10 years before this, right? So, at big banks around the world, I've never heard that term. I'm like, what exactly is active market maker? And so when you were to look at the description that they put out publicly back then, it was really about, well, active market making is really about, kind of helping your price goes in a direction that makes sense for you, the client. They're like, oh, what? Like that sounds very, very manipulative potentially. And so what exactly may have happened in some of these examples? This is a super popular structure that we kept on hearing about. Thank God, less so now, because some bad examples have happened and people are like, oh, actually it's dangerous, but still very crazy and very far from the normal job of the market maker. So this is how it works. Founders are being told by these active market makers that they have a solution for the price of their token. You don't like the price of your token? It's a bit like an engineering problem that you have on your protocol. It's a bit like a bug that you should squash. We have a solution for it. We can help you put the token price wherever you want it to go. Sounds awesome, right? For someone who's not necessarily a veteran of markets and who don't realize that the price of something should be really left free, right? That's exactly why it's trading in the market, so that the market can determine its value. It's like, oh, I want to put the price of my token higher if I could, right? And so this is how it works. How do you send the price of a thing higher? Well, you buy. Pretty simple. Ideally, you buy with as few sellers as possible. being present in the market. Of course, the fewer sellers there are, the easier it's going to be to send the thing higher. Right? It's super simple. So you start with a very low circulating supply. You can say the circulating supply is whatever you want, as you well know, I'm sure. CoinGecko, CoinMarketCap, they receive the circulating supply number directly from the protocol. So there is zero DD, zero check there, right? So you can really put it anywhere you want on the screen, but the true circulating supply should be small. That's step one. Step two, you need to get cash. You need to get cash because that's how you buy the token, right? So, and then with cash, now you can start to send the price of the token higher. Okay, great. That's a good recipe. It's a sensitive recipe. And it makes sense. I mean, if there is a lot of demand in the market and you and I and we all want to buy the same thing, it's going to go up. Well, how do you get cash out of thin air? Because this is not about fundraising or anything like that. It's about finding cash for the foundation. Well, you can sell something, but you cannot sell liquid tokens. Otherwise, it stops making sense, right? You sell liquid tokens to buy them back. No, it doesn't work. So you have to sell tokens that are locked. These tokens, you cannot actually, the person buying them from you is not going to receive them until 3 months, 6 months, 9 months from now, right? However, you get the proceeds today. You get the cash today. That sounds wonderful, right? So you get a pile of cash today, and you've only sold tokens, but you're only going to sell them in a few months. Perfect. Now, of course, there's a catch, right? Because the buyer of the token, it has to wait 3, 6, 9 months, maybe even longer to get their hands on the token. They're going to buy it at a heavy discount. Right? Back in the day, 6 to 9 months ago, that discount was about 20, 30%. Lately, on some tokens that have abused the system, let's say the discounts have gone to 70, even 80%. Okay, so think about it again. You sold one token that settles in 6 months. Against it, let's say for $1, against it you got 20 cents. Okay, now you got to sell 5 tokens to get $1 today. Wow. Okay, so to be able to buy a token today, you need to sell 5 tokens in the future. Now you start to see how things maybe can go wrong. But that's a problem for the future. What the active market maker is saying is, hey, don't worry about it. Don't worry about the future. With all the cash, you're going to send the thing up, great momentum. Because you can have great momentum, you can have great BD opportunities. You can point to your token saying, look at what a success story we are. And as a result, you can really kind of fake it till you make it. It's a bit like putting a rocket to orbit, right? Once you reach escape velocity, boom, you're going to breach the Earth gravity. And now you're set, right? And then stuff will be sold later, but it doesn't matter. People will love your project, love what you're doing. The problem is if you run out of fuel before you reach escape velocity, to keep with this image. Now, what could happen? Well, if it's only a 6 to 9 months later, if you bring back some of these charts, if you look at the scale, actually the dump happened a few weeks after, right? 3 weeks, maybe even 1 month after. So how does that work exactly? Why would you sell something locked for 3 weeks later? They most likely didn't do that, right? Them or other people. What probably happened is that the deal was for 6 months. However, think about it from the point of view of the buyer. Those are usually liquid funds, right? So liquid funds, hedge funds, sometimes attached to a VC, completely separate from the VC function, by the way. Sometimes a straight hedge fund who said, sure, I'll buy something 80% discount to get it 6 months later. But these guys are looking at the screen as well. And they see the price going up and they're like, oh, I like this. This is good. I'm making money on this trade, right? I cannot realize that P&L just yet because I'm getting the tokens later, but that's nice. I like that position. And then they start to see the rocket fuel starts to run out because the cash runs out, right? Because you run out of people to sell these tokens to. And so the liquid funds are like, oh shit, it used to go up 10% every week. Now it's not doing that anymore. So maybe the first time that actually the few people in the market that have tokens start to sell, the liquid fund is like, whoa. I don't want to be the one holding the bag here. So I'm going to sell. I can't sell tokens. I'm going to sell perps. And so usually if you were to plot the funding rate of the perp alongside the spot, you would see pretty much exactly like that scenario or maybe a few minutes before. But it starts with the perp funding rate dropping like a stone, like 20, 30% per day are sometimes like completely normal, right? When these things happen, even more. And the idea is the first liquid fund starts to sell perp. Now that they sold the perp, they're hedged. Right? There's short perps, there are long lock tokens that they can get rid of, but because they sold the perp, okay, they realize their P&L. However, the next liquid fund, well, now they're selling the perp, but at a lower price and a lower price. And so everybody piles onto the trade. Everybody who bought the lock tokens piles onto the short perp, pushing the price of the perp lower until people are done hedging. And by that time, of course, the price is decimated, right? Because the short perp, the funding rate is super low. So anybody who has long tokens, by the way, that's probably the active market maker as well, buys back the perp, sells spot. And so the perp weakness percolates into the spot weakness. And then you have a decimated price chart way before the unlock happens. Nothing might happen on the unlock because now these guys are completely hedged. But now you destroyed your chart, right? And now every time you're going to go see someone, whether in your community or a builder, or it's going to be hard to look serious because like, what happened here? And that chart is starting to be famous, right? And so this is not so much pump and dump. This is really not normal market making, liquidity providing. This is active market making, buy spot, sell in the future, and really, by and large, toxic structure that cannot end well.
That's such a fascinating story because I think people see these charts and they know there's some funny business going on behind the scenes, but it's interesting to like hear a mechanism of how that might work. I'm curious just how prevalent you think this is, and also, do people get away with it? Because it sounded to me like you were saying you're essentially creating a Ponzi-like structure for your token, with the sense that, well, it's going to reach escape velocity, and so you're kind of leveraging your future. But if the price of the token keeps going up because you keep finding new buyers, everything's fine. It's like the MicroStrategy trade. So I guess like two-parter. But first of all, how prevalent is this active market making, just from what you see? And secondly, does active market making work for projects ever?
Fantastic question. So before I answer the first one, I want to caveat it that there is strong selection bias to what I'm going to say, simply because CoinWatch is about bringing transparency to what market makers are doing. Any company that is putting in place these deals with active market makers are not interested in having transparency at all. They want the exact opposite. They want these deals to stay in the dark. They want nobody to know, nobody to be the wiser, for that to happen until escape velocity is reached. The last thing that they want is to bring in a third-party expert on this stuff who's going to start to, hey, show us your KPIs because we need to track them, etc., etc. And then, of course, not that we go to the police, but they just don't want to have another pair of eyes looking at that. So just talking to clients, talking to potential clients, going to a number of conferences and keeping a finger on the pulse of the industry as a whole. Apparently, this is absurdly prevalent, to the degree that I can count on the finger of my hands the number of clients that we have. We have about 50 paying clients today that have not been approached by these active market makers, sometimes even looking like white knights, sometimes looking, big firms that are dipping their toes into it, about these structures, about how we can fix your token price, we can protect your token price. And I want to be clear. This has always existed, fly-by-night operations like Web3 and unfortunately many others. But the fact that it has become a lot more, let's say, popular, or there are many more founders, even on the higher end of the quality spectrum in our industry, are interested in it, to me comes from a change of, excuse the word, but vibe in the crypto industry since the new administration took office, and since there is a general feeling that it's okay. It's okay. Whatever happens, you'll be able to get out of it, and probably nothing bad will happen. And so people are willing to try things that, quite frankly, their legal counsel or their big investors, even just a few months ago, would have said, "Are you completely insane here?" So extremely prevalent, unfortunately. That's to answer your first question. Remind me your second question.
Are people getting away with it?
Oh, okay. Yeah, very interesting question as well. Again, all rumors. It sounds like yes. And I want to also say that lock token deals are not a bad thing in and of themselves. A number of very serious, very large foundations have done lock token deals in the past, and absolutely fine. Sometimes publicly, sometimes privately. It's really about how do you use the proceeds. Right? Is it to fundraise? Is it for capex? Is it for normal business operation and grow your business? Or is it simply to put it in the token, and actually the buyers of the lock tokens have no idea how many people are involved, etc., etc. So the answer is, the earlier you did this, the easier it's going to get to get away from it, to get away with it. As you can see, the window with which the market may, kind of ring the bell of reality for you is getting shorter and shorter, right? It might have been 9 months before. Now it's only 3 weeks, right? And the discounts are getting deeper and deeper because liquid funds are getting wiser, right? Because even at an 80% discount, if there was any liquid token deals done on any of the graphs that you showed me, none of them are making money, right? Unless you were the first to sold the perp at the top of the market. And even then, the funding rate has bitten hard into your P&L for these couple of days that the perp was extremely negative. So nobody's happy about this. And an interesting thing that we hear from the market makers that we work with, the very serious companies we work with, that they hate being involved in these deals, like the Movement lab story, right? Web3 is, of course, the deal that everybody talked about, but Movement actually signed a number of other very legitimate market makers. Those market makers are probably going to be dragged into court as part of some proceeding to say what the hell happened here. These guys did not sign up for this. And probably as a market maker and making markets, they probably were actually buying tokens from Web3 Port when Web3 Port was hammering the price to try and make as much money for themselves as possible. So the general legit ethical market making industry is really not happy about this. Liquid funds are really not happy about this, right? They thought they were getting something at a discount. Actually, they were getting toxic waste into their balance sheet. So, and apparently the gig is up. So certainly, since Cannes, just a couple of weeks ago, this seems like the trend to put on these structures. People are waking up to the fact that, oh, actually, there is a lot of risks attached to it. It's unfortunate that they were not surfaced before, but so is crypto. And hopefully people don't have too short of a memory this time.
Yeah. I guess that's a follow-up is just where you see this trend going. Because there's a couple interesting pieces there I want to underscore for listeners. So one is that Trump gets elected, a bunch of lawsuits are dropped by the DOJ. The SEC shows that it's more friendly to the crypto sector, and some of these shadier market making deals start. And it sounds like you almost get FOMO among founders, where it's like, well, this guy over here signed this deal, and his token has done nothing but go up, and he added $200 million to his net worth. Why don't I just go and do the same thing? But the reason that this is sort of a diminishing return type of thing to do is that, as you said, if liquid funds wanted, an 80% discount or something on the tokens before, but they're getting burned, now they're going to say, well, forget that. I want a 95% discount. Your margins are squeezed even more. So I'm curious, do you foresee, because and one last point is just those charts that I showed, I believe all of them were the first 6 months of 2025, and you can throw movement in there as well, and a couple other kind of well-known funny looking charts. And it seems like this has been a really big story of the first half of this year. Do you think it continues, or are there just no deals left to be had for these sort of active market makers?
Super interesting questions. I think the first sign that this is starting to get played out is exactly what you point out, the steepness of the discount. Discounts used to be, by and large, for tier one crypto projects, 20 to 30% for 6 months. Right, that's kind of what was on the table, give or take. Right, you would go to your lead investors. Sometimes they would be happy to add on, etc., etc. And then liquid funds were not necessarily involved after that. Nowadays, 70, 80%. Right? So already the price, the whole structure starts to make sense, because as you said, right, if you need to sell 5 tokens in the future to be able to buy one today, what are you doing exactly? When it was 1.2 to buy one, okay, you can pretend everything's going to be fine. When you have a huge cliff of 5x the amount that you bought here to face in 6 months, plus the normal unlock, because most tokens unlock after a year, right? And then you have a chunk of just tokens that go to the team, the foundation, etc., etc. I mean, you're not making your life easier. Number one, the economics stop to make sense, even for someone who's like, oh, this guy did it 9 months ago and it works. Well, let's check price today. Price doesn't work anymore. Number one. And number two, I think some of these founders who might have been happy while the thing was going up, now they're not happy anymore. There are some rumors that the Mantra founders are on the run, and that they cannot go back to Dubai. And these charts, I mean, once you have them, they're there for posterity, right? And that is, I don't want to say that's it. I would love for, these teams to recover and to pivot, or however they're going to do it. But certainly you lost a good chunk of credibility for the protocol and for yourself, for the founding team, for the execs who made these decisions. So that is really where I hope that the pendulum, I think, is swinging back, right? And we see more and more people saying, no, I'm not going to get any close to that because it's extremely toxic. It's very short-term optimization. I'm very grateful to see it and to hear about it. It's crypto, right? This is not the only stupid trade that you can put on. There are a number of ways to get cash today and to get people to buy your token, etc., etc. The fake it till you make it is still very prevalent. The fact that there is a general agreement that nobody's looking on the regulatory side kind of means that active market makers still have sunny days in front of them, in my opinion. But it's a shame that it comes at the cost, usually, of very good team, very serious founders who unfortunately fell to an alluring pitch. When it sounds too good to be true, usually it is.
Yeah, and one point that I've heard sort of offhandedly here and there is basically, look, the president of the United States launched a meme coin. I can do anything. And we just saw a lawsuit get filed in the Movement Labs case. Like, you're not the president of the United States, and maybe he can get away with stuff. Maybe he can't, but you certainly are not immune. to legal action over your bad deeds if that's what you're doing. One last point on this shady market maker stuff. I want to ask about other actors, because we've talked a good bit about, what the active market making firms of the world are doing here. But it strikes me that in the process of launching a token, there's a number of other relevant actors, and maybe the two most important would be like founders / insiders and exchanges, where, as you said, the founder has some toxic incentives at play here, where they can drastically increase their wealth by trying to manipulate the chart. And exchanges, profit off of volatility. And to them, ultimately, they don't lose money if a token loses 99% of its value necessarily. So how do you divvy up blame when we see like some of these high profile blowups? And is it up to founders? Is it up to exchanges? Like, do they have an ability to prevent some of this as well?
Right. That's also a very interesting topic. So let's talk about founders. For sure. Right. If they were not doing these lock token deals in the first place, yes, it's a foundation, but let's just say that somewhere the founders has given a nod and has given the okay. Rushi might say that it was completely out of his hand, but come on, I mean, yeah, the decision was made, and usually the boss is the one making the decision. So yes, in my opinion, the bucket stops there. And the fact that they're too gullible, you're the founder. The buck stops with you. Exchanges, it's a very interesting point. I don't think exchanges actually enjoy this at all, right? Because exchanges, you have to remember, so there's two competing things. Exchanges want to make money, but they also really want their users to make money. That's their number one KPI. Because if you keep on losing money when you go to the casino, you can stop going to the casino, or you should stop to go to the casino. But so exchanges, they don't really want to see this huge blowout. They're super happy when things go up. Exchanges made money, clients make money, our users made money, and we did a launch pool and blah, blah, blah. It's a fantastic story. But then when everything goes down, you cannot imagine, I worked at a couple of exchanges in the past. You cannot imagine the amount of customer tickets that exchanges get when prices go down. I want to be reimbursed. I want to be refunded. That's not what I signed up for, right? Yeah. So they have to deal with that. It's not good. It's not good for them. It's not good for their users and the image. Even if everybody listed, it's still a problem. However, exchanges still bear a lot of responsibility on another aspect of crypto, which is actually even more prevalent than what we've been talking about, which is what happens at launch. It's a bigger subject. We can dive in later if you're interested. But at launch, exchanges have a very strong incentive to have the thing be as volatile and as explosive as possible. Why? Because when things explode higher, emotions kick in. Again, I traded for 10 years as a job, right? So the first thing that you learn as a trader is to have a plan and stick to the plan and try and keep your emotions under wrap. And if you cannot do that, analyze that nearly like a psychiatrist. Like, what did I do wrong? What did my emotion get in the way of trading? In crypto, very few professional traders, retail at least, would have this disciplined approach. And so when things go up a lot, people buy more, right? And buy and buy and buy more. And so this is the famous shape where things go up like crazy, right? Because the thing is 3-2-1-0, wow, everybody rushes at the gate. And airdrop recipients who are trying to pick the top and also trying to claim the token is going to take time. So they typically are not ready at the first second to sell on exchange. They first got a deposit. It's going to take time, especially if it's a new layer one, etc., etc. So the wave of buying usually is not met with a wave of selling. They happen consequently, linearly, right? So a lot of buying, everything goes up, and a lot of selling through the next couple of days. And people are like, oh, I hope it goes back up, and then it doesn't, and so they sell and sell and sell more. This means that the token is kind of doomed. Because why is that? Because the initial price is for posterity set super high, really by crazy buyers who are buying at market at crazy prices. As a result, the benchmark for the eternity of your token is that price on day one, even in the first hour, that first candle. Why is that? And then people are like, oh, crypto is down only. Well, it's down only because the initial price is always invariably way too high, right? And so exchanges bear a lot of responsibility here because they could have a much more orderly price discovery. They have no real incentive to have an orderly price discovery. Remember that a big exchange was telling me that on a decently large launch, so not a giant pump or giant bear chain, like a normally large launch that goes well, they can make $10 to $20 million in a couple of days.
Wow.
Right? So yeah, so that tells you that do they want to fix the volatility? Do they want to have people to have acquired, a calmer head and a calmer hand when they trade? Absolutely not. Do they want to replicate the kind of discipline and organization that there is around an IPO? Absolutely not. They want to keep things to be completely crazy and wild, and they bear a lot of responsibility on that front.
Wow, that's that 10 to 20 million is so interesting. Like, you can see why, yeah, there's a lot of incentive to just launch new tokens. I'm curious to just get, and I don't want to get too sidetracked here, but you mentioned price discovery, and we've had an interesting conversation about this in the past. Just, I mean, pump funds token was the big story this week, and I think it got listed at like 5 billion FDV, but the ICO happened at 4 billion FDV, and that chart looks good for now, but to your point, it started trading much above where everyone bought into it. So, and yeah, the initial price discovery in crypto is often lacking. So, do you have thoughts on how to deal with that issue as well?
For sure. And it's a question that I invariably will address with any client that has used CoinWatch to negotiate their market making deal and to get ready for their token launch. Because typically they're going to approach us and say, hey, how do I choose my initial price? How do I choose my initial price? It's a fantastic question. It's a question full of dreams, right? It's like you can choose actually where the price goes. Actually, it doesn't work that way at all. Let's look at what happens in crypto, and then we can draw the parallel to what happens in the TradFi world, in equity world. In crypto, when you want to be part of the price discovery process, when you want to have a say over where is going to be that first candle, you got to be part of the price discovery process. You got to be either a buyer or a seller. If you're neither of these things, you are not involved. You are not deciding. And that's a very, very, very important point I want to make. Founders, foundations, execs of tokens that are about to launch do not decide the price at which the token will list. That's super important. They do not decide unless they are in the order book themselves, unless they start to sell at a certain price, they start to buy at a certain price. And then, of course, then they're going to be part of that consensus. Otherwise, they don't. Another thing that people probably don't realize, VCs do not decide. VCs, by and large, I've never seen a deal or a launch when VCs, or okay, it happens, right? Safe and a few other examples. But mostly VCs, insiders, teams do not have tokens at launch. They do not have tokens at launch. They're going to vest, they're going to cliff many, many months after launch. So they're not part of the process as well. Finally, market makers. Big boogeyman, market maker who's on who the responsibility always lies. Typically, market makers are part of the price discovery process, but not really at launch. Remember, at launch, the instantaneous volatility, 1,000, 2,000%. Hell no, you're not going to market make there. We track market makers real time, right? So we know exactly who's doing what, who's in the order books. I can tell you, the first couple of hours post-launch, nobody's in the books. Nobody is in the books. There isn't a single dollar of orders in the books. And I'm not going to go through the names, but nobody does it differently. Nobody wants to be catching the falling knife or just selling before the thing is about to jump 5x. So market makers have a thing to do at launch, which is hedge their call option in the scenario where they got an option, of course. Hedging that call option means selling a part of the loan, right? Between a quarter and half of the loan is roughly going to be the delta of the call option, depending on how the option is made. If it's a large deal that you extended to your market maker, because you didn't talk to CoinWatch before, and so the deal is gigantic, that's going to be a lot of tokens that they're going to sell. But these tokens are not trying to sell them in a continuous basis to calm the volatility. Absolutely not. They're a hedge fund. What do hedge funds want to do? They want to make money. How do you make money when you're long something and it goes up a lot? You sell at the top. You don't sell a little, you sell how you want to sell, but the way you maximize your P&L is to pick the top, and then you start to sell. So that's very, very important to realize. So really the price discovery at launch is driven by people. The buyer, that crazy buyer who's buying at market, any size, any price, that's the person who establishes the first candle. And that's a problem because, as I said, this sets the stage for disappointment. It cannot not be a disappointment, or 99% of the time, that price is completely unmoored from reality. And invariably, founders are going to say, wow, I love that day one price. Yeah, I'm an FDV of 5B, absolutely. And then a few weeks later, they're back down to reality, to whichever FDV they thought they had in mind for their project, whatever, call it 600 mil, 700 mil, and they're super angry. Like, what happened? It's my market makers who sold everything. Is the fault of the market maker? Typically, no. It's just that the initial price was completely insane. You cannot rest on that. You cannot have that in your mind as something that made sense. So how does the normal world does it? I think it's worth spending just a bit of time thinking about that. Why do equity don't have this problem? It's because you have a much more orderly process in place that has been around for more than 100 years, right? That's why when you keep on trying to reinvent things, it's great. But really, a lot of humans, bankers, have thought about this stuff for a long, long time. We also can reuse some of what has been done there. Part one, establishing an initial price. It's called the IPO price, the underwriting price. That's exactly what Pump did with their 4 billion price, right? They did a giant sale a few days before token launch that anchors the price. The price of the thing is $4 billion. Okay, great. At launch and after launch, there should be a volatility reduction mechanism. In traditional finance, that's called the green shoe option. That option is essentially, very schematically, to simplify, it's a little more complicated than that, but to simplify, it says that if the IPO does extremely well, the bank that is leading the IPO, that is managing the mechanics of the IPO, has the right to increase the size of the IPO, meaning to issue more shares, to grow the size of the IPO. By adding supply, they're going to calm things down. Or they can do the opposite if the price goes down. They can reduce the size of the IPO. As a result, less shares are going to be issued, which is going to provide support to the token price. So part one is now being explored. CoinList has been around for a long time, and Echo and Plasma has done something with Sonar. Pump did it just on their own recently. So the part one is pretty much well-charted territory, right? We sell some tokens. The closer you are to token launch, of course, to do that deal, the better. It doesn't mean you cannot have upside like Pump. But what's important, in my opinion, is that to avoid the crazy runaway price, which Pump, in my opinion, is not, and Hyperliquid is not, etc., is to avoid the 2 times 2 times 3 times 4 rise in price, which invariably will mean a down 70, down 80% a few weeks down the road. It is that the project should have that green shoe option built in, which is something like selling tokens continuously if the price of the token launches above IPO price or token launch price, and that proceeds that are put in the smart contract, that's not for the founders, that's not exit liquidity, it stays in the smart contract, and it's only unlocked and used to buy back the token if and when it trades below the token launch price. Now you have a stabilization mechanic after launch. That green shoe is valid for a month in traditional finance. You could have it much shorter in crypto. One thing that's important is that, again, we go back to that subject of selling the future for today. The lower the foundation is willing to sell tokens at, the better they are setting themselves for success. It might seem counterintuitive. It's like, well, they're selling something for cheap, but think about it. When Plasma is selling 10% of their network at 50 million valuation, when they could probably have achieved 10 times more, that means that starting price, if they have the stabilization mechanism in place, that starting price will be very low. It will be way easier to impress from it than starting at 5B. And that is a winning strategy. So, of course, nobody wants to sell cheap, right? Foundations are saying, we worked hard. I don't want to sell my tokens cheap. Sure. But by doing so, and by selling enough tokens that the price is representative, you set yourself up for success, because you get out, or at least you massively reduce the likelihood that you're going to get a down-only chart.
Interesting. I like that phrase, selling the future for today. I think that characterizes a lot of the issues with crypto markets, because it's so easy to just instantly sort of create new capital out of thin air. And the short-termism is kind of the enemy in crypto. So it's well put. I want to ask a little bit, Matt, just about your business, actually, which you've alluded to sort of throughout the episode. But it's, I was reporting the Movement Labs story earlier this year, and one of the real revelations that came out of that period is how complex the token launch process is behind the scenes. There's all sorts of deals, and it feels like the innovation goes where the money is, and there's a lot of money in token launches, and so there's a lot of innovation. And then it's really interesting to me that firms like CoinWatch now exist who kind of help people navigate that in general. It's like almost a consulting firm. But I'm putting words in your mouth, but I'm curious kind of where your business steps in this whole process.
Sure. Let me go back in time a little and tell you how this all came about. So I was, as I said, a market maker for 10 years, and I decided to move to crypto after that. I really wanted a change, and CoinList hired me as a product manager, and I had no idea what I was doing. I didn't know what a product was, and so I'm like, okay, well, let's look for a product to build, I guess. And so back then, CoinList was doing the big token sales of that was in 2019, by the way. So Solana and Filecoin and Celo and Flow and these massive ETH killers, as they were called back then, would come to CoinList as the only one-stop shop to do their token sale. And invariably, all of these foundations, all of these teams would come to CoinList and say, hey, by the way, we're about to get listed on Binance and Bybit, etc., etc. we apparently need market makers. Can you guys help us out? Because we're talking to, it would be always the same names, Jump, GSR, and Wintermute. Keyrock was already there, but smaller. We don't know what we're doing. We're technologists. We're experts at building great tech. We don't know what a market maker should do. So can you help out? And CoinList was like, well, we have a guy over there in the corner who could help. And so that's what got me started. I negotiated the first market making deals of these clients I just mentioned. And the idea back then was simple. I'm going to help you out getting a slightly better deal because, God, these deals were insane, right? Like massive, way too big. I mean, I think Compound, I don't know if it's in public domain now, but rumors that they lent between 5 and 10% of their total supply to their market makers for their market making deal, which is completely insane when you think about it. And so looking at these things, it was pretty easy to improve on these deals, right? I would have a couple of market makers and say, hey, what's your price for this liquidity on OKX, on Binance, et cetera, and get to a better price, to a fairer price. The payment for that was not consulting at all. It was, hey, by the way, when you're about to list, make sure that in the contract with your market maker, you're going to list CoinList on top of Binance and Coinbase and Kraken, so that CoinList is going to get great liquidity for free, which for a nascent exchange that CoinList was back then was huge. So I was really the first person to do these things as a kind of advisor, right? And fast forward to today, CoinWatch, we've been doing it for the longest. We've been around for about 3 years, but there's a number of other advisors that have cropped up, that have seen what we've done, and that have replicated a lot of it. At the core of it, you have two businesses. You have an advisory business, which is around negotiating better deals, better market making deals for our clients, deals that are fairly sized, deals that our clients can get out of if it goes wrong, deals that have clear liquidity targets, right? These things sound super normal, right? They were not. Just a few years ago, they were absolutely not. Some of the clients that have benefited from our help include Optimism, Sui, Morpho, Jito, Euler, Aptos, and many, many more. We talk about, as I said earlier, 60 plus clients through this process, so really through not only negotiating the market making deal, helping them negotiate with exchanges, and accompany them on the TL token launch, right? Because a lot of stuff happens, a lot of things need to go on, not only the market making deal itself, but also how many tokens you're going to distribute, which market maker on which exchange, etc. And founders have a lot of other things to think about than sexes and market maker around launch. So we help alleviate them of that. Now, we quickly realized that having this advisory function is terrific, and clients were super happy about it to get a better market making deal. But if you don't track your market maker, you were missing a huge part of the equation, simply because you can have the best piece of paper in the world. If you don't verify, not much is going to happen, right? For a simple reason, as I said earlier, market making, it can be extremely costly in crypto. When there is arbitrage to capture, great, but arbitrage is not market making. Arbitrage is selling on this marketplace over there and buying back from this other marketplace there, and vice versa. That's not providing two-way liquidity when shit hits the fan, right? That's completely different. So market making is expensive, and so if you don't track market makers, by and large, are going to be like, actually, kind of Homer Simpson disappearing in the bushes. And so I went to the co-founder of CoinList and one of my good friends, Brian, and I said, Brian, I need you. Brian was kind of in between two jobs, terrific engineer, fantastic guy. And I'm like, Brian, I need two charts. I need charts to track the market makers. I need to check the volume, and I need to check the depth and the bid offer spread. 3 charts, sorry. And Brian is like, okay, sure. I'll help you out. And so today we have CoinWatch Track, which has gone way beyond 3 charts. And CoinWatch Chart is this crazy innovation that we came about earlier this year at the end of Q1, which is about our ability to connect to market maker API keys. It's the holy grail of market making, of tracking your market makers, simply because now you know exactly at the source in real time what your market makers are trading, what kind of trading volume they're generating, what depth they're streaming, what bid offer spread they have in the order book at all times, trustlessly from the exchange. And so, the product has evolved a lot, but now I feel like we've arrived in a place that I never thought would be able to arrive just a few years ago when we got started, and we're super happy to make this available to every crypto protocol so that they can keep tabs on their market makers in a way that was thought impossible.
I'll be curious to watch kind of how this plays out. The last thing I wanted to just ask you a bit about, Matt, is you alluded to the fact that you got your start in crypto at CoinList, and that I think you sort of, in some capacity, worked on the Solana ICO, which I just find pretty interesting. I wasn't investing in Solana at the time, unfortunately, to my portfolio size, but I'm just curious if you have any interesting stories or unknown tidbits about the kind of Solana ICO days in your view of it?
Well, it's a very interesting question again. Solana did their token sale on CoinList famously, and it was at I think they did two token sale actually. The last one was at 74 cents. And back then, it was actually right at the beginning of COVID, early 2020. And back then, so I was also myself, I had just been at CoinList for a year. I had a lot of knowledge around market making, but not so much crypto market making. I was really dabbling into this new industry, and I was trying my best. But so the Solana team approached me, like a few others, CoinList clients, to negotiate their market making deal. And so we ended up negotiating a deal with one market maker, as was pretty common back then, because there were so few market makers around that you could not really hire more than one. And I don't know if people remember, the listeners of this podcast, but when Solana launched, it only launched on one exchange, on Binance. That's kind of crazy to think about now that Sol is as ubiquitous as Bitcoin, but it only launched on Binance, and that is always a very tricky situation when you only launch on one exchange, even if it's Binance, simply because if that exchange decides to threaten you with delisting, it's literally a death sentence because your token is nowhere else, right? So, and DEXs, of course, were nowhere near the size, the kind of market share that we see today. So that's actually exactly what happened, right? And so Binance, and this is all in the public domain, so I'm not super shy to talk about it. At launch, right, the token price went to 90 cents. And the community started to tweet at Binance and Solana and saying, "Hey guys, in your tokenomics, you mentioned the fact that these were the tokens that were circulating, and this amount for the foundation, this amount for the team, but we see a big transfer here to an entity you didn't talk about. What is that?" And Solana is like, "Well, that's our market maker, right?" And the community was up in arms, and they're like, "What the hell? What? No. That's not cool. You should have told us." That's not right. We want our money back. And the thing was already up a lot, probably, right? But okay, a lot of pressure on Binance. And so Binance turns around and publishes a public blog post to say, Solana, either you make this right, the market maker sends you back the tokens, or trouble is coming your way. And so then we go into a bit more of a confidential territory. But ultimately, what ended up happening is the market maker told Solana, "Well, guys, we hedged our delta, so you gave us an option, and that option has delta, and so we are going to hedge part of the delta." By the way, the worst trading decision ever for them, right? Because they started to sell Sol at sub $1, right? So very, very stupid decision. But from a trading perspective, selling your delta is normal when you get an option. You just keep the other risk, but hedge that one. And Solana is like, "What do you mean you sold the delta?" "Well, we sold a chunk of the loan." But no, and the market maker was extremely firm. Like, "Hey, look, I mean, we have a deal. We are a prop firm. We can do what we want with the loan. We sold what was reasonable, and we have the rest provided as liquidity. But that's just how it is." And so then I stopped having visibility in the negotiation. More market making deals, of course, have been signed throughout the years through Solana, but it's really, really fun to think back and to reflect on that time when Solana was at the mercy of Binance to be delisted, and as a result, were at a knife around their neck, and to be like, okay, whatever Binance wants, we need to do. This has happened many, 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 many times over, right? Binance exerting pressure on teams to get stuff right at the last minute, and it's all in the public domain usually because Binance is extremely vocal about it. And what you see usually is a delay of listing, right? Or the listing is going to be delayed a few more hours. Actually, in the background, it's usually heavy negotiations happening to get extra, or to just get more. Binance is certainly a very large actor and throwing their weight around as consequences. And I'm sure many participants to the podcast can tell you horror stories about big listing deals on Binance Alpha and others who ended up costing a lot. But yeah, that's for the good old days back when Solana was tiny, and it was also for me a very big learning experience.
That's really interesting. That's actually new history to me. So Solana has this market making transfer. Binance says, "Hey, send back the money, or we're going to do something real bad." And then it turns out that the market making firm had already sold. So like, and you just don't know what happened next. I get, like, presumably behind closed doors, they were like, "Hey, don't do this, Binance."
Well, so it's like the guy said, we sold, it's all right, and we sold only the portion that made sense, the delta of our call, and this is how we priced it, etc., etc.
Yeah.
I don't no, or cannot really say much more about what happened afterwards. But yeah, the team was extremely angry about that, and yeah, it ended up being everything was fine,
Yeah.
and things got sorted. But well, pretty intense to think that and it would have been the best trade again for them, right, to buy back at 90 cents and then run it into the sunset. But hindsight is 2020.
Yeah, yeah, clearly. Wow, what an interesting little tidbit from early Solana history. That's a good nugget. Um, Matt, that is I think we're gonna end it there. It's been a fun conversation. I feel like recently on Lightspeed we've been having like a market structure mini series. So this is the latest installment, and I learned a ton about how market making works in crypto. So thank you so much for coming on the show, and yeah, best of luck with what you're trying to build out in this space as well.
Thank you, Jack. And yeah, we're gonna go live and public about CoinWatch Track, our new tracking solution, on Monday. And yeah, hopefully you like it, and you'll give me some feedback.
Great. Listeners, if you made it this far, thank you so much for tuning in. We really appreciate it. We'd love if you'd give us a like, a 5-star rating wherever you get your podcasts. If you enjoyed this show, please share it with a friend, and we'll see you all again very soon.